let's talk a little more about what this means for the Fed's calculus, because the February PPI print showing that inflation still remains sticky. Top line and producer price rising 0.6% on a monthly basis. That was more than what forecasters have been expecting. We also got a read on the consumer this morning. Retail sales rising in the month of February, rebounding from the decline that we saw in January. Also pointing to the fact that shoppers are still out there spending. So let's talk about what this all means for the path forward for the Fed. For that, we want to bring in Lindsey, the chief economist with Stifel. Lindsey, it's great to have you here. So we've been scratching our heads a little bit just in terms of the fact that traders are still pricing in 3 rate cuts between now and the end of the year. Is that your base case, or what do you think the Fed is likely to do on the heels of these latest prints?
I think given the stickier than expected nature of inflation, it's going to be very difficult for the Fed to justify a near-term rate reduction. Our base case is that the Fed holds off to the second half of the year before initiating a change in policy. Now, the market, as you mentioned, has capitulated from at least a March rate hike out to June. But I think even that is overly optimistic, again, given the latest inflation data, suggesting that we may continue to see the Fed on the sideline for much, much longer than expected if we're unable to see evidence that inflation is retreating back to that 2% target.
And Lindsey, as far as the evidence goes about that inflation, those inflation numbers not quite getting to 2%, we've seen headline CPI plateau over the last year. Supercore, we don't hear much about Supercore anymore, but that's services ex housing that has stabilized above 4%. So what is the risk that the Fed has to chase inflation to the upside once again?
Well, the risk is that the Fed didn't raise rates to an actually sufficiently restrictive level, that they stopped short of where we should have seen that backup in policy. And they are allowing inflation to become further entrenched the longer they sit on the sidelines and the longer inflation remains above that target. So the risk is that inflation remains above these levels, above 2%, and the Fed is eventually forced to come back into the marketplace and continue to raise rates. Now, that's going to be a very difficult sell to the market, because the Fed has clearly communicated that they're comfortable with this current terminal level of 5.5% on the upper bound. But should inflation remain stagnant, that means the Fed's on the sideline. Should inflation reverse course meaningfully, that means the Fed may have to come back in with additional rate increases.
And Lindsey, we've discussed this with you in the past, but there's just been more and more chatter about that 2% target, whether or not that makes sense in this post-pandemic economy and what the current landscape is right now. How are you looking at that? And what do you think that will ultimately tell us here in terms of the Fed's policy over the next 12 to 18 months?
Well, if you listen to the Federal Reserve commentary regarding the 2% target, the Fed chairman specifically has been very clear. He said 2% is our target. It's always been our target. It always will be our target. So he clearly is not wavering from that mandate of 2% nominal price growth. Longer run, the Fed may be more willing to have a conversation to provide them additional wiggle room in terms of that inflation target. But right now, they cannot deviate from that 2% target without potentially sending inflation expectations much higher, which would feed back into the real read of inflation and simply compound the difficulty for the Fed to reinstate price stability.
And I want to take a quick detour to the jobs market, because we did get some jobless claims numbers this morning, 209,000. Street was expecting more. And then on continuing claims, that also came in light at 1,800, 11,000. Just wondering what the labor situation is. We have a tight labor market. It's remained that way. How does this fit into your Fed calculations?
Well, the Fed has a very clear dual mandate: stable prices, full employment. When we look at the labor market, it's very clear, whether you look at the pace of job creation, the initial jobless claims, wage growth, all of these components suggest a very tight labor market. So the Fed can comfortably check the box of full employment, suggesting then that their full attention at this point is getting to that second goal of price stability, reinstating stable price pressures in the U.S. economy. So that is entirely their focus. That is their directive at this point. And unfortunately, market conditions have simply posed more and more challenges to achieving that goal.